Good afternoon, my friends in Singapore. Nice to see you again. I'll try to finish on time today. I'm not sure if you have had your lunch, so I'll try to finish on time so as not to get you stuffed. Okay, today I'll share with you the strategy and stock picks for the second quarter of 2023. These are the key discussion points today. There will be quite a lot to cover, so I'll try to manage the time today. Okay, so in the first quarter this year, the Shanghai Composite Index was up 5.9%. Actually, you can see from this chart, there was not very big movements on the Asia market, on the Shanghai Composite Index. It was stuck between 3,150 to 3,340. So it was moving in a rather tight range. The Sunshine Composite Index was up 6.5% in the first quarter this year. It met resistance above 12,000, but received support, saw support around 11,500. As for the Hong Kong stock market, Hang Seng Index was up 3.1% in the first quarter, but it moved in quite a big range in the first quarter. It hit a high of 22,700 in late January, and then fell to a low of 18,829 in mid-March. Since hitting the low in mid-March, it has been rebounding. Now it has rebounded to about 20,000. Last Friday, the Hang Seng closed at 20,400. So in the first quarter, we saw a range of nearly 4,000 points on the Hang Seng Index. As for the Hang Seng Tech Index, it hit a high also in late January, around 4,825, and subsequently it fell to a low around 3,750, 3,750 in mid-March. It bottomed out 1 week before the Hang Seng Index. You can see in this chart, it bottomed out 1 week before the Hang Seng Index, and since then it had been rising quite steadily. Now it's risen back to 4,300 from a recent low of 3,750. Okay. China's economy grew by 2.9% in the fourth quarter of 2022, compared with a year earlier, down from the 3.9% growth seen in the third quarter. Because the fourth quarter last year, China was still impacted by the zero COVID policy. They only started to relax the policy early this year. So this was not reflected on the economy yet in the fourth quarter last year. So this brought the economic growth rate for 2022 to 3%, which is the second lowest since 1976, since the death of the deceased chairman Mao Zedong in 1976. And it was below the government's target of 5.5% for 2022. It refused a hard hit to the Chinese economy from a zero COVID policy, as well as a property rout in 2022. But at the start of 2023, we saw China's economy showing a mild but mixed recovery. So in 2023, Chinese policymakers have vowed to seek a turnaround in the economy to be backed by the end of zero COVID and also a series of property support measures that will revive domestic consumption and bolster growth. And just last month, the PBOC, People Banks of China, reduced its reserve requirement ratio, RRR, by 25 basis points. In March, there was another reduction, another cut since December last year. set to release 500 billion yuan to support bank lending and to boost the economy. Okay, let's take a brief look at the economic data, the recent economic data of China. Fixed asset investment growth has gained speed, as you can see on the left-hand side. The fixed asset investment for the first 2 months this year, the growth rate accelerated to 5.5% from 5.1% for 2022. This is also supported by real estate investment. The decline is narrowing. So we reckon that the fall in real estate investment slow as home sales, developer investment, and construction starts recorded narrower declines. In the first 2 months, real estate investment dropped by 5.7%, much less than the 10% decline in 2022. Okay, property sales reflect that the property sector is drawing closer to exit from a protracted slump. Home sales by floor area on the left, you can see from the chart on the left-hand side, home sales by floor area in the first 2 months of 2023 fell only 3.6% from a year earlier, compared with a 24% decline for the whole of 2022. The narrower sales decline followed the rise in new home prices in January, which is the first uptick in a year in 12 months. As buyers, while still cautious, found solace in a slew of supportive policies and expectations of more stimulus steps and China's exit from its crushing zero-COVID regime. So we expect the property sector will be coming out from the woods, from the protracted slump. On manufacturing, industrial profits rebounded, a rebound expected in following months. On the left-hand side, the chart shows value-added industrial output. China's value-added industrial output went up 2.4% year-on-year in the first 2 months of 2023, with rising production demand and improved market expectations. However, industrial profits dropped more in the first 2 months, dropped 22.9% in the first 2 months of 2023, mainly dragged down by the Chinese New Year holidays, while industrial enterprises were also adjusting to the country's optimized COVID-19 response measures. So we do expect industrial profits to rebound in the following months after the sharp drop in the first 2 months this year. Okay, on consumption, retail sales are expected to continue to rebound. Retail sales in China recorded a 3.5% year-on-year growth during the first 2 months of 2023 as consumer spending rebounds after end of COVID curbs. So you can see that after 3 successive months of negative growth, retail sales finally turned positive in the first 2 months this year. However, the National Bureau of Statistics warned in a statement that the economic recovery's foundation was not yet solid and said the government would take measures to boost domestic consumption. Okay, on inflation side, both CPI and PPI inflation remain subdued in China. China's consumer price index rose by 1%. You can see on the chart on the left-hand side, the growth rate decelerated from 2.1% in January to 1% in February, as both food and non-food inflation fell. On the right-hand side, it shows the PPI, which declined by 1.4% in February year-on-year. So there's persistence of producer deflation, combined with persistence of producer deflation and moderating consumer deflation, we believe there's more room for the government to support economic recovery by rolling out more fiscal policies as well as monetary policies, stimulus policies. Okay. Last week, the National Bureau of Statistics, China National Bureau of Statistics, has announced the official manufacturing PMI, Purchasing Manager Index, and the non-manufacturing Purchasing Manager Index. The manufacturing PMI expanded for the third straight month in March. You can see from the chart on the left-hand side, the official manufacturing PMI stood at 51.9 in March, slightly down from 52.6 in February, but still marking the second highest level in almost 2 years, and also remain in expansion territory 3 months in a row. On the right-hand side, it shows China's official non-manufacturing PMI, surface PMI. March surface PMI came in at 58.2, up from 56.3 a month earlier, and also hitting a 12-year high. So both official manufacturing and non-manufacturing PMIs indicate economic recovery is on track. This morning, the Caixin also published their China manufacturing PMI. It fell from 51.6 to 50, in line with the trend shown in the official manufacturing PMI, moderating from January, but still remain above 50 in expansion territory. Okay, our 2023 outlook of China's economy. First of all, China sets a GDP growth target at around 5% for 2023, which is considered moderate following a low base in 2022. Last year, as I mentioned just now, China's economy grew at around 3.5%. So this year, the official target was set around 5%. China's economy showed a mild but mixed recovery at the start of the year, but its resilience could still be tested by domestic employment. Unemployment rate among the young people still rather high, around 15–16%. So it remains a headwind to economic growth recovery this year, and also real estate pressures, whether we'll see continuous pressure on the real estate market, and also the complex external environment. This will act as headwinds to the expected economic recovery this year. So we need to be more cautious this year. Inflation increased to 2% in 2022. The whole year inflation rate was 2%, well below the 3% official target. And for 2023, the official target, inflation target, is also set at 3%, but the actual inflation level is expected to be around 2% based on the current situation, economic environment. And with the Fed's tightening campaign nearing an end, we believe that China's monetary easing will face fewer constraints. So there will be more room for China to stimulate its economy. And we expect a higher GDP growth rate for China. We expect 5.4% GDP growth for China in 2023. Okay. We also, on the Yuan outlook, on renminbi outlook, China's yuan has rallied since the beginning of 2023 on investor optimism, the recent policy support measures and also reopening will bolster an economic recovery in China in 2023 that will lend support to the yuan. And also the end of the Fed's interest rate hike cycle, coupled with slowing economic growth in the US, will restrict the dollar's attractiveness. On the other hand, cross-border capital inflows are on the rise as overseas investors have been seen snapping up A shares since the beginning of 2023. We see more capital inflow into the Asian market, more northbound fund flow. The yuan is expected to have more room to appreciate against the dollar in 2023. So this chart shows that the yuan has quite solid support around 7 yuan to 1 US dollar. It has tested the 7 yuan support level a few times in late February, and also early March. And since then, it has rebounded to around 6.9 yuan to 1 yuan to 1 US dollar. Our forecast range, yuan forecast range for the second quarter is between 6.77 to 7. This is our yuan forecast range for the second quarter. Okay. I saw some questions coming in. If you have any questions, you may please feel free to leave your questions either in the chat box or the Q&A box. Okay. Okay. There's one question about the Hang Seng Index, which I will reply later when we talk about the index targets for the second quarter. Okay. Okay. Shanghai Composite, our Shanghai Composite Index forecast range for the second quarter is between 3,150 to 3,420. So we believe there is a bigger upside in the second quarter, because in the first quarter, the Shanghai Composite Index met resistance around 3,340. We do expect it will be able to move a bit higher in the second quarter, providing that the economic growth picks up momentum further in the second quarter. Okay. For the Sunshine Composite Index, we are expecting range between 10,900 and 12,600 in the second quarter, slightly higher than the peaks around 12,300 seen in January. Okay. Hang Seng forecast range is 19,500 to 21,600. So we are expecting a higher level, slightly higher than the 21,000 level seen in early March. Alex asked if the Hang Seng is forming a head and shoulder pattern that may signal a downward movement if the pattern is being established. Yes, only if it breaks the neckline, it breaches the neckline support around 18,800. So this is the leg line. This is the leg line. Yeah, but if it manages to rise about 21,200, it will see a much higher right shoulder. So it may disrupt the head and shoulder pattern if it manages to rise about 21,200. And also we use Fibonacci ratio to calculate the rebound. This time the Hang Seng Index dropped from 22,701 to 18,829, dropping by 3,872 points. So if it rebounded 0.618%, 0.61.8% of the decline, it will rise to 21,222. So if it manages to rise above 21,222, then it may not be a rebound. It may be another new uptrend. For 2023, personally, I am quite upbeat on the Hong Kong market. I am envisaging a N-shaped pattern for the Hang Seng Index. The first leg up is from 14,597, the low hit in October, last October. And then it peaked around 22,701 points. So the rally, it has risen more than 8,000 points in this leg up. Okay, after rising for more than 8,000 points from late October last year to early January this year, it had corrected close to 50% of the rally. The 8,000 plus points rally has dropped, as I mentioned just now, 3,872 points from the peak seen in late January. So it has corrected close to 50%. And since hitting a bottom of 18,829, now is up on the uptrend again. So we are monitoring if it manages, it will ultimately rise above 21,200. If it rises above 21,200, then it may gel with our a projection that the Hang Seng Index will be forming an N pattern this year. So this leg up will see the index to be able to rise to 25,000 to 26,000. That will imply a 6,000 to 7,000 points rally from the recent low of 18,800. So this is our projection for the Hang Seng Index so far. But of course, we will revise along. Okay. The Hang Seng Tech Index, our forecast range for the second quarter is between 4,100 and 4,500. So now it has rebounded nearly 61.8%. It has rebounded more than 50% of the decline from 4,825 to 3,754. It has rebounded more than 50%. Now it's heading for the target of 61.8% rebound, which will put the index at 4,420. So if it manages to rise above 4,420, it may also be more than a rebound. It will be another up wave instead of just a technical rebound. Okay. Okay. ETF. We follow up with our Phillip Hong Kong newly listed equities index ETF 2835. This is the first ETF launched by PhillipCapital Management Hong Kong. It aims to replicate the selective Hong Kong newly listed equities index. It is also the first ETF listed on the Hong Kong Stock Exchange focusing on Hong Kong IPO market. Okay, there's a quarterly rebalancing, and on top of the quarterly rebalancing, there's a monthly review for IPO listed every month, so as to admit those newly listed companies into the index if they qualify. Okay, so this is a so-called fast-track mechanism. Okay. This selective Hong Kong newly listed equities index, the methodology, the stock universe include all the common stock listed on the Hong Kong EX, but only those listed no longer than 756 trading days will be qualified for the newly listed equities index. Companies that are listed more than 756 trading days will be removed from the index regardless of their performance, so that we can make way for the index can make way for more newly listed companies that have good growth potentials. Okay, so there is a market cap requirement, minimum of share class market capitalization 1 billion Hong Kong dollar market capitalization, and minimum free float market cap of 25%. And also the index emphasizes liquidity. There's a minimum average median daily value traded over 1 month trading period, and the average daily value traded is 10 million Hong Kong dollars. And then the qualified stocks are sorted by free float market capitalization. Maximum, there are 50 stocks, 50 constituents in the equities in the index. Okay, just now I mentioned the monthly IPO review day. It will during the monthly IPO review day, securities that had a recent IPO can enter the index. It will rank in the top 50 by highest free float market capitalization, respective to the existing index components. Okay, this is a glimpse of the top 10 holdings as of 30th March. Alibaba was just removed because it was listed more than 3 years in Hong Kong. So in our last quarterly rebalancing in December, Alibaba was removed. Now other tech companies that rank among our top 10 holdings include NetEase, Baidu, JD.com. There are also old economy companies such as Yum China, ZTO Express, Zhongtong Kuaidi. These are and also Ke Holdings. These are regarded old economy companies. So unlike the tech index, we reckon that this selective Hong Kong newly listed equities index is more diversified. There's a better diversification with different sectors. As of September 30th September last year, the sectoral breakdown, you can see on the right hand side, media and entertainment account for about 27% of the ETF of the index, and then retailing account for 22.5%. Automobiles and components account for about 15%. Consumer services account for 12.6%. So you can see on the left-hand side, the GICS industry group breakdown is quite diversified with exposure to real estate, food, beverage, and tobacco, transportation, pharmaceuticals, biotechnology, and other sectors. Okay. As I mentioned just now, there are more non-tech new economy companies in the index, including Yum China, 中通快递 ZTO Express, Longfu Spring, which is represents the beverage industry, 华住酒店, leisure facilities and education companies such as New Oriental. Okay. So we are more diversified, not only in terms of sectoral exposure. We have more constituent stocks than the Hang Seng Tech Index. There are maximum 50 constituent stocks in the Phillip Hong Kong newly listed equities index, whereas the Hang Seng Tech Index only have maximum 30 constituents. Okay. This ETF, the stock code is 2835, Phillip Hong Kong newly listed equities index ETF 2835, was listed in November last year. It was quite a good timing, as you can see on the chart. The listing price was 10 Hong Kong dollars. So it only dipped below the listing price very briefly, only for 2-3 trading days since listing. And then it remained above the listing price. It climbed to a high of 12.91 Hong Kong dollars in early February, representing nearly 30% gain from the listing price, also in 2 months' time since listed. And then it followed the market to correct to around $10.60 in early March, and since then it has rebounded now to $11.50. So we can see in this chart that there is quite solid support around $10.50 level, the $10.50 level. Okay, this shows the relative performance of 2835, the ETF, the Phillip Hong Kong newly listed equities ETF with the Hang Seng Index. The black line represents 2835. So it most of the time you can see it outperformed the Hang Seng Index most of the time, and also by sometimes by a very wider margin when the market is on a bullish trend, as shown in early February this year. So up to now, year to date, it was up 19.1%, whereas the Hang Seng was only up 15.5%. Okay. These are the quick facts of the ETF. Trading board lot size is only 100 shares. Based on the current market price of $11.50 Hong Kong cents a year, 11 Hong Kong dollar and 50 cents. The one board lot will cost around 11,000 Hong Kong dollars. Okay, PhillipCapital Management Hong Kong is the manager of this ETF, and PhillipCapital Management Singapore is the sub-manager. Our custodian is HSBC. The ongoing charges over a year is 1.5%. Management fee is 0.6%. Estimated annual tracking difference will be less than 2%. Okay, the base currency is Hong Kong dollar, and the trading currency is also Hong Kong dollar. There will be no distribution, dividend distribution to be made. Okay, for more details, you can visit our Hong Kong PCM website, phillipfunds.com.hk. Okay, the Hong Kong IPO market. Hong Kong has been the #1 IPO venue globally in 7 out of the past 12 years. This is the outlook, 2023 outlook. Both PwC and Deloitte believe Hong Kong can remain in the top 3 international IPO markets in 2023. In 2022, Hong Kong ranked the 4th behind Shanghai, Shenzhen, and South Korea. But this year, both PwC and Deloitte believe Hong Kong can remain in the top 3 international IPO markets, backed by various positive factors and developments, including a slowdown in US interest rate hikes and reopening of the Hong Kong and mainland boundary. Deloitte expects Hong Kong to see 110 new listings, raising about 230 billion Hong Kong dollar. Last year, there were only around 90 new listings in Hong Kong, raising about 100 billion Hong Kong dollars. A slew of regulatory reform set to be implemented soon will also benefit Hong Kong's IPO market this year. These include changes that allow a broader range of pre-revenue technology companies to list under the so-called Chapter 18C. Earlier, the Hong Kong Exchange has applied the Chapter 18A to allow pre-revenue biotechnology companies to get listed. So in the last 2 years, there are a lot of pre-revenue biotech companies being listed on the Hong Kong Exchange, and some of them have very good price performance after listing. So we're expecting the advent of pre-revenue technology companies to be listed on the Hong Kong's EX under Chapter 18C. And recently, Yuan denominated stock trading has been introduced. Counters with both Hong Kong trading, Hong Kong dollar trading, and Yuan trading will be available to investors. This may appeal to Chinese investors who are holding Yuan for investment. And also the inclusion of Hong Kong listed overseas companies in the southbound leg of the stock connect mechanism, the so-called 中概股, now being made available for investment by mainland Chinese investors under the Stock Connect scheme. And also recently announced Alibaba and JD spin-offs, probably the spin-offs, if being listed on the Hong Kong EX, will also benefit the Hong Kong IPO market. So this is the Hong Kong IPO market outlook this year. Okay, stock picks. One key theme I would like to share with you this time is SOE valuation system with Chinese characteristics. In Chinese, is known as Yang Te Gu in the short form, abbreviated form. Yang Te Gu. Yang stands for Yang Qi, state-owned enterprise. Te stands for Te Chinese characteristics with 中国特色. Gu stands for valuation. So Yang Te Gu means SOE valuation system with Chinese characteristics. It was first raised by the chairman of the China Securities Regulatory Commission, Yi Hui-man, saying that China will explore ways to establish a valuation system with Chinese characteristics, which will help improve the current low valuation of state-owned enterprises, SOEs, as the low valuations limit the ability to tap financial markets and hurt the capital markets development, and also not in favor to the SOEs, as they, if they need to raise money to expand their business and develop their business. How low their valuations are, you can see low listed SOEs now trade an average 14% discount to book value, while the broader market is valued at 60% premium to NAV, to net asset value. So a big contrast, a big contrast in terms of P book, price to book value. Although the Chinese authority has not announced how they are going to raise how they are going to improve the low valuation of SOEs, we believe there are plenty of ways to boost valuations, such as rolling out incentive plans, asset injections, spin-off to unlock the hidden value of some SOEs, or increasing the dividend payout to make it more attractive to investors looking for yield, and also stepping up corporate governance, because in the past, institutional investors do have reservations about the corporate governance of SOEs. So one way to boost valuation is to step up the corporate governance. Okay, and the State-Owned Asset Supervision and Administration Commission, SASAC, has launched a campaign of value creation actions to benchmark SOEs against world-class enterprises. So we expect this trend to continue. Actually, starting from February, you can see in this chart, the blue line is the CSI 300 index, the blue line, CSI 300 index, which represents the broad market. The white line is the CSI, China Security Index, sub-index, the Central State-Owned 100 Index. Okay, so it underperformed the CSI 300 Index until late February. You can see the crossover. Now CSI Central State owned 800 index is outperforming the CSI 300 index, and the margin by a bigger margin, and widening margin. So we expect this to continue. There are three sectors we favor. In the oil and gas sectors, these three stocks, you can see the valuation and the dividend yield. PetroChina is trading on 5 times historical PE and yielding 10% in dividend yield. Sinopec 386 trading on 7.5 times historical PE and yielding 8.8% dividend yield. CNOOC 883 is trading on 3.4 times PE and yielding 12.4%. Among these three stocks, the so-called 3 buckets of oil, 三桶油, our pick is PetroChina. You may ask why why our top pick is not CNOOC, as it is much cheaper and has a higher dividend yield. Because CNOOC is more sensitive to oil prices, to crude oil prices. Its business is more upstream centric. So its financial results are more susceptible to the crude price level, and they are both positive and negative factors. Currently, they are both headwinds and tailwinds for crude oil prices. So we reckon that CNOOC is less, the outlook is less certain. It will be affected by the movement of the crude oil prices. Okay, PetroChina, the share price rises quite steadily. It outperforms the broad market. Just now, if you remember the Hang Seng Index chart, the Hang Seng Index chart, after peaking out, after hitting a high of 22,700 in late January, it started a decline, a correction to 18,800. But you can see that PetroChina share price continue its upward move in the last 2 months. So it actually outperforms the broad market. Okay. Financial highlights of PetroChina in 2022, the group achieved a revenue of 3,239 billion yuan, representing an increase of 23.9% as compared with 2,614 billion yuan for 2021. Profit attributable to owners of the company was 149.38 billion yuan, representing an increase of 62.1%. So net profit rose faster than revenue growth. The board recommends a dividend payout ratio of 67% for the full year of 2022 and a total dividend of 4.41 Hong Kong dollars per share for the full year of 2022, up by 8.6% year-on-year. So now it's trading at $4.70 and it's paying $4.41 last year. So the dividend yield is close to 9%. As of December 31st, 2022, the gearing ratio of the group was only 17.4%, down from 19.5% as at December 31st, 2021. So the relatively low gearing ratio would enable the company to continue to pay generous dividend to its shareholders. Business outlook for PetroChina. China's economic growth is expected to rebound in 2023, driving the demand for refined oil. In 2023, the group plans to reach the crude oil output of 912.9 million barrels, compared with 767.4 million barrels in 2021. So quite a significant increase year-on-year. And the marketable natural gas output, PetroChina produces not only crude oil, but also natural gas. The marketable natural gas output plan this year is 4,888.9 billion cubic feet, compared to 4,471.3 billion cubic feet last year. So a 10% expected rise in terms of natural gas output. With a total oil and natural gas equivalent output of 1,727.7 million barrels, compared to 1,512.6 million barrels in 2021. In terms of refining, it plans to reach the processing volume of crude oil of 1,293.1 million barrels, also higher than the 1,212.7 million barrels processing volume in 2021. Additionally, the group will control the gradual decline of old oil field production. Some of its oil fields are old oil fields are producing less crude oil. So you control the gradual decline of those old oil field production and improve the collection rate of old oil field and focus on the construction of new areas and strive to improve oil and gas production. As we are aware that this environmental protection, environmental concern will result in lower consumption in fossil fuel over time. So PetroChina is also diversifying into the new energy business. Its new energy business is vigorously promoting wind power, photovoltaic power, gas power, geothermal, hydrogen energy, and other projects. Okay. The second sector that will benefit from the Yang say SOE valuation with China characteristics is the telecom sector. Among the in the telecom industry, these three state-owned enterprises stand out, namely China Mobile, China Telecom, and China Unicom. China Mobile is currently trading on 9.5 times historical PE and yielding 7% dividend yield. China Telecom, slightly higher, the PE is 12.2 times and dividend yield around 5.4%. China Unicom is trading on 9 times historical PE, but yielding 5.5% dividend yield. So obviously, our topic among the telco stocks in China, SOE, SOE telcos, is China Mobile. Okay, its share price also outperformed the broad market. It just hit a recent high of $66.1 and started correction, a very mild correction in late March, in the second half of March. Less than 10% correction from the recent peak of $66.1. It saw support around $61. So it has only corrected around $5 from the peak. Financial highlights of China Mobile. Its operating revenue was 937.3 billion yuan in 2022, up by 10.5% year-on-year, of which revenue from telecommunication services was 812.1 billion yuan, up by 8.1% year-on-year. For many years, the operating revenue of Chinese telco companies grew at low single digit. Last year was the first year we saw double-digit growth in operating revenue demonstrated by China Mobile. Its digital transformation revenue reached 207.6 billion yuan, up by 30.3% year-on-year. So the growth rate acceleration in operating revenue growth was actually driven by digital transformation revenue and especially mobile cloud revenue. Its mobile cloud revenue in 2022 was 50.3 billion yuan, up by 108.1% year-on-year. So together with China Telecom and China Unicom, actually the three telco operators have snatched a big chunk of the market share of the mobile cloud market from private enterprises such as Alibaba and Baidu. Okay. Profit attributable to equity shareholders was 125.5 billion yuan, up by 8% year-on-year. Total number of mobile customers was 975 million. They ranked number one in terms of mobile customers in China compared to China Telecom and China Unicom, of which number of 5G package customers was 614 million. And mobile ARPU increased by 0.4% year-on-year to 49 yuan last year. Total number of wireline broadband customers was 272 million, of which number of household broadband customers formed the main bulk was 244 million. Household customer blended ARPU increased by 5.8% year-on-year to 42.1 yuan. Business outlook for China Mobile. China has provided very favorable policy support to increase the strength, quality, and scale of its digital economy. The recently issued plan for the overall layout of building a digital China and opinions on establishing a database system to maximize a better role of data elements aim to accelerate the development of digital China and continuously unleash the potential embedded in data elements. So China Mobile would tap into high-value areas such as video content and cloud computing, while establishing its presence in frontier areas, including the metaverse, autonomous driving, and smart robots. China Mobile and other Chinese telco operators all have a role to play in these areas, such as metaverse, autonomous driving, and smart robots. It expects dividend payout ratio to rise to over 70% this year. Last year, as I mentioned earlier, the payout ratio was raised to 67%. This year, the board expects dividend payout ratio to rise to over 70% as capital expenditure has peaked. 5G capital expenditure has peaked in 2022, and 6G will not come that soon. CapEx for 6G will not kick in, I think, only after 2024. Okay, so they are able to maintain a high dividend payout ratio. The third sector under the SOE valuation with Chinese characteristics under this theme is the infrastructure play. Okay, there are three companies we have shortlisted: China Communication Construction, 中交建, stock code 1800, China Railway, 中铁, stock code 390, and China Railway Construction, 中铁建, stock code 1186. All three are trading at very low PE, between 3 and 4 times PE for 2022, and dividend yield around 5%. Okay, our topic in this sector is China Railway Construction, 1186. Its share price also outperformed the market since year to date, after rising to a peak of 6.38 Hong Kong dollars. Now there's a mild correction to around 550, to between 540 and 550. The correction slightly more than 10% from the recent high of $6.38. Financial highlights of China Railway Construction. In 2022, the group achieved revenue of 1,096 billion yuan and net profit of 31.75 billion yuan, which realized year-on-year growth of 7.48% in revenue and 8.32% year-on-year growth in net profit. The value of newly signed contracts in 2022 amounted to 3,245 billion. So it's 3.2 trillion yuan, completing 112.83% of the annual plan and representing a year-on-year increase of 15.09% as compared to the value of newly signed contracts in 2021. So despite the adverse impact brought about by the COVID pandemic in 2022, China Railway Construction managed to beat its annual plan of newly signed contracts. Okay, business outlook remain upbeat as China continues to support major projects to promote coordinated regional development of traditional infrastructures such as transportation, energy, and water conservancy, and also the construction of the new infrastructure, including new urbanization initiatives and major projects such as data center, high-speed rail transit, 5G, automobile charging power. Despite its name, China Railway Construction, actually the company is not the company's business operation is not confined to railway related projects. It's also providing services in energy, water conservancy, and mobile connectivities, so on. Okay. By the end of 2022, there were a total of 14,038 PPP projects. PPP projects means public-private partnership projects that involve a partnership between the government, provincial government, and private enterprises. So this will form this will provide the growth momentum for China railway construction for new contracts acquisition. With these 14,038 PPP projects had a total investment of 20.92 trillion yuan. Wow, it's huge, 20.92 trillion yuan investment. As of 31st December 2022, the amount of incomplete contracts of the group, the backlog on hand, total 6,362 billion yuan, representing a year-on-year increase of 31.06%. So at least 2022, 2023, and 2024 operating income is somehow warranted because of the huge contracts, huge amount of contracts on hand that it will complete in the next 2 years. Okay, so now we come to the last part of my presentation. Our take on the new tech, new economy companies, ATMJX. Alibaba, the outlook is brightening. During the quarter ended December 31st, 2022, revenue was 247.75 billion yuan, equivalent to $35.92 billion, an increase of 2% year-over-year. Income from operations was 35 billion yuan, or $5.079 billion, an increase of 396% year-over-year, primarily due to a 22.4 billion yuan decrease in impairment of goodwill in relation to digital media and entertainment segment. Adjusted EBITDA was 52.048 billion yuan, or $7.546 billion, an increase of 16% year-over-year. Free cash flow was 81.514 billion yuan, or $11.818 billion, an increase of 15% year-on-year. The company, because of strong cash condition, the company repurchased 45.4 million ADS under its share repurchase program as part of its ongoing commitment to improve its shareholder return. And the latest development that's positive to the company is Jack Ma's returned to China last week. After living outside of China for more than a year, Alibaba's founder, Jack Ma, finally returns to China. And there's more positive interpretation of his return to China to the company. Alibaba also announced the split into 6 units, which would allow each division to seek out its own financing or even to apply for an IPO. And Ant Financial also said it had cleared by regulators to move forward with an IPO. So we expect a few major spin-off and IPO listing for Alibaba's subsidiaries, subdivisions in future, which will help unlock the potential value of the company. Okay, its share price moves mainly in line with the broad market, also hitting a high, also peaking out around 118 $78.5 in late January and fell to 78 Hong Kong dollars in mid-March. And since hitting that low, that recent low, its share price has rebounded quite strongly over the last week on the news of the spin-off of Jack Ma's return to China, as well as the spin-off of those subdivisions. Okay. Tencent also, we reckon that the company's outlook is also brightening. Although revenues decreased by 1% to 554.6 billion yuan for the year ended 31st. This is our estimated support level and resistance level for Alibaba. Near-term support is 94 Hong Kong dollars. Next support will be $90. Near-term resistance 108. Next resistance level is seen at 115. Tencent, the profit attributable to equity holders last year decreased by 16% year-on-year to 188.2 billion yuan because both its gaming and online advertising segments are adversely impacted by the COVID pandemic last year. Industry conditions were challenging in the first half of 2022. Tencent managed to streamline its core structure, rationalize non-core businesses, and initiated new revenue-generating services, which enabled it to resume earnings growth in the second half of the year. During the conference call after result announcement, the company said that January and February were showing positive signs of a sustained recovery. It should see a rebound in 2023 as China's macroeconomic environment stabilizes, which will boost its advertising and gaming businesses. Chinese regulators are seen granting a batch of new game licenses signals every month now. It resumes the granting, the issuance of new game licenses since, I think, May last year. And every month they issue new game license in the number of, in the range of 80 to 90 new domestic licenses every month, and around 30 overseas licenses in the last announcement. It may signals that Beijing was easing its crackdown on the gaming industry, and Tencent stresses that it would take advantage of every license it has obtained and focus on the quality of games. Okay, Tencent share price also hit a high of 416.6 Hong Kong dollars in late January, and then subsequently started a correction, fell to around $330 in early March. It saw good support around the $330 level, and in the last 2 weeks, its share price started to rebound. Last Wednesday, its share price rose to close to 400, the 400 psychological level. Okay, our near-term support for Tencent is 365 Hong Kong dollars. Next support is 345. Near-term resistance expected around 400 Hong Kong dollars, and next resistance level about 400 Hong Kong dollars is 415. Meituan, competition is heating up. Revenues increased by 22.8% to 220 billion yuan in 2022 from 179.1 billion in 2021. Adjusted EBITDA and adjusted net profit were 9.7 billion yuan and 2.8 billion respectively, turning from loss into profit on a year-over-year basis. Its core local commerce segment achieved 17.6% revenue growth, despite negative impacts from the macro environment. And operating profit of its core local commerce segment increased by 56.8% on a year-over-year basis to 29.5 billion yuan. And operating margin improved to 18.4%, up from 13.8% in 2021, so up 4.6 percentage points. Revenues from the new initiative segment, including Meituan Select, Meituan Youxuan, and Meituan Grocery, Meituan Maicai, increased by 39.3% on a year-over-year basis to 59.2 billion yuan, mainly driven by growth from the goods retail businesses. Operating loss narrowed to 28.4 billion yuan, while operating margin improved to negative 47.9%, primarily attributable to improvement in operating efficiency from the goods retail businesses. Meituan was reportedly considering expanding food delivery service outside mainland China, with Hong Kong as its first step. Actually, it has begun hiring delivering crew in Hong Kong. And but investors need to take note of ByteDance, 字节跳动, Douyin, Chinese version of TikTok, is now testing food delivery in China, suggesting it wants a slice of the food delivery market in China, which was worth $66.4 billion US in 2022. So with the advent of ByteDance, Douyin, we expect, and also competition from Alibaba's competition in the food delivery market in China will become more intense. Meituan underperformed the market. You can see recently it hit high around 195.6 Hong Kong dollars in early January, nearly 1 month in advance compared to the broad market. And since then, it has dropped to 120 Hong Kong dollars, dropped 75 dollars from the recent high, and now only rebounded to 140 something. Okay, near-term support is expected around 135 Hong Kong dollars, and below 135, the next support level is expected to be 128 Hong Kong dollars. Near-term resistance is expected around 150 Hong Kong dollars, and next resistance is 165 Hong Kong dollars. Okay, JD.com also similar to Meituan is facing heating up competition. Net revenues for the full year of 2022 were 1,046.2 billion yuan, an increase of 9.9% from the full year of 2021. Net service revenues were 181.2 billion, or 26.3 billion US dollars, an increase of 33.3%. Net income attributable to ordinary shareholders was 10.4 billion yuan, or 1.5 billion US dollars, compared to a net loss of 3.6 billion yuan in 2021. Non-JAP net income attributable to ordinary shareholders was 28.2 billion yuan, or 4.1 billion US dollars, compared to 17.2 billion yuan in 2021. During a conference call, JD Chief Executive Xu Lei said that it will take a relatively long time for stimulus measures approved by Beijing to work their way into consumers' wallets. And launching of a 10 billion yuan or 1.5 billion US dollar subsidy campaign in early March to compete against rival Pinduoduo signals competition heating up as China's e-commerce market slows down. Okay, so it's facing competition from not only Alibaba's Taobao and Tmall, but also from Pinduoduo. Its share price quite similar to the performance of Meituan, also peaked out in early January around 258.6 Hong Kong dollars, and then fell to below $150 in mid-March. The rebound was rather mild. It has only risen by around 10% recently to 172. Our near-term support is for JD.com is $160, and next support is 150 Hong Kong dollars. Near-term resistance projected at 190, and near-term next resistance above 190 is 205 Hong Kong dollars. Okay, last one, Xiaomi. It achieved progress in its premiumization strategy. Total revenue in 2022 was 280 billion yuan, representing a year-on-year decrease of 14.7%, and adjusted net profit plummeted 61.4% to 8.5 billion yuan, as there was an expenses of 3.1 billion yuan related to its smart electric vehicle and other new initiatives. Its smartphone business remained resilient, and there was progress in its premiumization strategy. In 2022, its smartphone revenue reached 167.2 billion, accounting for more than 50% of its total revenue. So it's still very reliant on the smartphone business. And its global smartphone shipments amounted to 150.5 million units, ranking it the third position on the global smartphone market. The average selling price, ASP, of its smartphones reached 1,111 yuan, setting a record high, thanks to its premiumization strategy. In the fourth quarter of 2022, its smartphone units sold in the 3,000 yuan to 4,000 yuan price segment, ranked #1 in mainland China. Those are regarded as high-end, premium smartphones. While its smartphone units sold in the 4,000 yuan to 5,000 yuan price segment, ranked #2 in mainland China. CEO Lei Jun said Xiaomi electric cars will see mass production by the first half of 2024, that is first half next year, implying that Xiaomi is pushing into another highly competitive market as it deals with flagging smartphone sales. So although there's progress achieved in premiumization in its premiumization strategy, its outlook remains uncertain regarding the weakening smartphone industry, as well as the very competitive car market, new energy car market in China. Okay, its share price followed the trend of Meituan and JD.com, peaking in early. Its share price peaked out in early February. Okay, more or less in line with the market, and then started a downtrend, a correction from 14.10 to around $11 to slightly below $11. Now it has rebounded to 12.1 Hong Kong dollars. We expect near-term support around $11.50, and next support level is $10.60. Near-term resistance is expected around 12.8 Hong Kong dollars, and next resistance is expected around 14 Hong Kong dollars. Okay, so that finished my presentation today. Thanks for your time.